Hello YouTube friends, and welcome to Grow Money Seeds, a channel about building wealth and managing your money. With thousands of stocks and securities trading on the stock market, how do we know what we should be buying and selling, or even what the general trend of the market is? In this video, we're going to look at technical indicators and how they can be used to help us navigate the market. Right, let's talk about this. This video is going to be part 1 of a 5-part series where we're going to be looking at using technical indicators to help trade the stock market. In this video, I'm going to discuss what indicators are, and in subsequent videos, we're going to look more specifically at some popular indicators. In the final video, we're going to put all of these indicators together to get a macro view of the overall market condition. To be a successful trader, it is vital to know the overall market condition, since most stocks tend to move in the direction of the market. Therefore, now might be a good time to click the subscribe and the like buttons so you are notified when the next video is released. Okay, so what are technical indicators? The definition of a technical indicator is that it is a mathematical calculation based on historic price, volume, or open interest information that aims to forecast financial market direction. This calculation is displayed visually on a price chart to help traders make a decision about what and when to trade. There are 5 main categories of indicators. The first are mean reversion indicators. These aim to identify when a stock is overbought or oversold, and if it is likely to revert back to its mean. If a stock is oversold, then it may be an idea to buy the stock with the expectation it will move up again, or if it's overbought, then sell as the stock may pull back. Examples of these would be the relative strength indicator, or the RSI, and the stochastic indicator. Trend indicators aim to identify if a stock is moving within a range, or trending upwards or downwards. Trading with a clearly defined trend can drastically increase your odds of being successful when trading, and it takes away a lot of guesswork. Examples of these are moving averages and the average directional index, or ADX. Momentum indicators, also known as oscillators, show how quickly or strongly the price moves over time from a midpoint. If a stock has good upward momentum, then you may want to buy the stock and capture some more upside. And similarly, if there is downward momentum, you may want to exit the position. Examples of these are the MACD and the Advanced Decline Ratio, or ADR. Volatility indicators shows how much activity there is in a stock. If the price moves up or down a lot, then volatility is high. And if it does not move that much, then volatility is low. Large movements in price can offer a trader the chance to make a high return. However, this can also increase risk. Examples of these are the average true range, or ATR, and Bollinger Bands. Finally, volume indicators look at the volume, or the number of shares traded. This may help determine if there is interest in a stock. If a stock has double the number of shares traded on a day, then this could be a sign that a stock has a potential move up or down and may present an opportunity to make money. Examples of these are the Accumulation Distribution Index, or ADI, and the Money Flow Index. Why do we use indicators? The main reason for indicators is for filtering out noise, which may help us then to determine if a stock is overbought or oversold, identify a trend, or find a potential opportunity. For example, if we look at Apple and add a 9-day moving average, this will smooth out the price action, which may help us make a decision about how we trade the stock. What is the problem with indicators? Indicators use past data, which means that indicators can't tell you what a stock is going to do in the future. In fact, signals can often be generated long after an event has taken place. We can see this by adding a 50-day moving average to our Apple chart. We might decide that if the 9-day moving average drops below the 50-day moving average, we will exit our trade. As you can see, during the recent coronavirus sell-off, we would have received our sell signal late when the sell-off was well underway. Some indicators are known as leading indicators, like the RSI, because they attempt to give a signal before the price changes direction. Lagging indicators, like moving averages, give a signal after the price has changed, but are good for determining trends. Just remember again that both leading and lagging indicators use past data. Another problem with indicators is that there are thousands of them, and this can cause a trader to be swamped with too much information. Too many indicators can lead to a messy chart and can cause information overload, which leads to analysis paralysis. What is the best indicator? I'm sorry to say, but the holy grail of indicators does not exist. When using indicators, it is best to use a few different ones from different indicator categories. A good idea is to use a combination of indicators that all confirm a similar signal. In summary, indicators are just tools that help you to analyze a security. Try to use more than one indicator from different indicator categories. Don't use too many indicators to avoid analysis paralysis. The holy grail of indicators does not exist, and no indicator can predict the future. Whenever you're trading, always remember to have an entry and an exit plan before placing a trade. So, do you have a favorite indicator or combination of indicators? If so, it would be great to know, so please leave a note or a comment in the description below. Thanks for watching, and I'll see you in the next video.